Bring in Bruce Richards, Chairman and CEO of Marathon Asset Management, a global credit manager managing $23 billion in AUM. Bruce, always good to have you. You have been warning that this year is going to look different for the equity market. Fed just told us it's looking at more aggressive and faster interest rate hikes and tightening of the balance sheet, the $9 trillion balance sheet. Is this a preview of what's ahead?
Absolutely, Sarah. Nice to see you. First of all, big fan of Mr. Powell and Chairman Powell, but he overplayed his hand and sat there too long with the transitory script, and it didn't work out so well. And all of America is going to be paying for that in the form of higher prices of inflation. So CPI is running at 6.8%, and PPI is running close to 10%. You see asset inflation everywhere, whether it was housing prices up 20% or fuel prices up, food. Look at pork prices up 25%, what people are paying for food at the supermarket. And so inflation is running. It's the supply chain. It's the demand function. It's the wage function as well. But what it really is, it's the fact that the Fed and Treasury took the money supply of this country and printed dollar after dollar for years after years. So money supply, M2's gone from 7 trillion to 21 trillion, threefold since the 2008 crisis, and nearly doubled over the last 5 to 6 years. And the supply that they've bought up in treasuries has also inflated the balance sheet, also enabled the printing of money, taking the balance sheet from under $1 trillion to 9 trillion, where it is today. So now that we know inflation is no longer transitory and is really running, the question is, how does the Fed respond? And they tipped their hand today. And when they tipped their hand, the markets didn't like it. And you'll see that throughout the course of this year. The year 2019, 20, and 21, equity markets were unbelievable. The best 3-year run for equities that we've seen this century, up 26% on average for the S&P. But look at 2018. That's your most instructive year. Equities went from being up 10 to down 10 that year, closing down 5% on the year. So it's a 20% pullback, and basically that's how I see 2022 playing out, because the Fed's ending quantitative easing. They're going to start to let their balance sheet run off, and they're going to raise rates. And when that happens, the market won't be prepared for it. You'll see a major equity contraction. And what you'll see is although earnings will increase, multiples will contract, and that'll be your noise. So when I look out the end of the year, I think that equities can be either side of zero, and it's basically a random walk. But there's a lot of volatility and a lot of risk between now and the end of the year.